Good afternoon. Thank you for joining us today for Business Succession Planning, Strategies for the Transition. I'm Brian Lawton, a partner at the Business Transactions Groups. I represent closely held businesses in a variety of legal matters, including structuring business succession transactions.
Hi, I'm Wayne Buckwalter. I direct the Wealth Preservation Group. We do a lot of work in planning business succession, helping business owners, families, employees plan for the next generation.
Should you have any questions during the program, please ask them in the questions section of your GoToWebinar panel. We'll address the questions as they come in as time allows. What we do is Wayne and I regularly counsel our clients on how to structure their exit of the business. And that involves a variety of circumstances, whether it's selling to third parties, finding key employees within your business that you sell to, handing over ownership to the next generation, or any combination of those. And a big part of that is to do it in a fashion that is going to work with your overall financial situation, including your estate plan. Typical clients involved in a business succession situation, they're in their mid-50s, 60s. They're interested in getting out the business. They want to reduce or eliminate their business risk. They're interested in enjoying life and moving away from business a little bit. And very often, they are heavily invested in their business in an emotional sense, and they want to preserve the value of that business for the employees, for their customers, and keep the business going. While we have a general type of client that we have, their individual client circumstances differ. It's not a one-size-fits-all situation with respect to a business succession. The factors that are important for the client really do depend. You'll have clients who are interested in exiting as quick as possible, getting as much money as they can out of the business. Other ones have some difficulty with the transition. They feel like the necessity to keep their hand involved in the business. And very often they're concerned about the impact of exiting the business is going to have to their clients overall.
Now, there's also some business owners that would like to just close the door one day and be gone. Sometimes they have to get used to the fact that that may not be the best way to go about it. But if you do the planning correctly, it makes things easier for your family. And if you have more than one child in the business, it makes everybody happier.
Too often people put off the planning process, whether it's you're so heavily involved in your day-to-day business activities that you're lose sight of the bigger picture. All of us have trouble with end times and the notion of kind of putting your head in the sand. Very easy, very appealing. You'll often find in our representation of clients the people who have waited too long. And the fact that you guys have decided to participate in this webinar today, credits owed to you because that shows that you're interested in this and you're thinking ahead. And that's really, it's never too early to start with respect to business succession planning.
Yeah, that's right, Brian. And if you really want to do the best job, you really need to be thinking about an exit strategy or a transition sometime between 5 and 10 years prior to the time you're ready to start doing something else. And even though you've talked to your certified public accountant, perhaps even had a business valuation done, that's not necessarily a guarantee as to what your business is worth. Ultimately, your business is worth what somebody's going to pay for it.
That starts with who's the next owner.
And you notice we have a blank slide there because we don't know.
And in terms of businesses, the vast majority of businesses in the United States are privately owned. And so the business succession in that circumstance is going to be a very personal thing to the person who owns the business. And the trend in the United States, Wayne had indicated that there's a 10 to 15 year horizon thinking about a business succession. The United States Small Business Administration is estimating in that 10 to 15-year time frame, approximately 70% of privately owned businesses in the United States will exchange hands. And this period that we're coming into is going to be the largest intergenerational transfer of wealth in the United States history.
Right. Like a lot of things, this is probably tied into baby boomers looking forward to moving on to the next stage of their life.
So what's the fate of the family-owned business? We know that the succession is going to happen. Well, if you look at this chart, it demonstrates how many businesses survive from one generation to the next. And I think the thing that really stands out is the striking decline as you go from one generation to the next. And it makes you wonder why it is that there is such a steep decline. I think a lot of us who are involved in family-owned businesses, we have some pretty good answers in terms of what's involved with that.
Yeah, interestingly, as you watch those pie shapes get smaller, the percentages go away, another thing that happens is money disappears. The value of businesses disappear. So one of the things that the hope is that with right planning, you're going to maximize the value of your business.
So that leads to the next question. Why is it that ownership transfer plans don't work? We have a lot of our listeners today who are involved in the construction and engineering industries, so it probably comes as no surprise to those listeners that the surety industry has studied this exact issue. And you look at those factors, the things that really stand out is it's internal matters to the company are what are the reasons why the business doesn't move from one generation to the next. And so that's the absence of having competent management, children who become involved in the business who don't have the capability of running it, or the key management, that second generation of employees leave because they've become frustrated with the status quo within the business. All of those are internal factors to that business.
And you notice the title of that slide, Surety Industry Survey. Well, one of the things that's come up, and maybe has come up for you, is a lot of times sureties and lenders really want to know what your business succession plan is, and that's a requirement of having the loan approved, having surety bonds put into place.
FMI Capital Advisors, which is a management consulting firm that focuses on the engineering construction industry, did a survey with respect to business succession issues. And they found that while the goal for most business owners is to transition internally, they find that internal plan often doesn't come into effect, and what they have to end up doing is selling to third parties. Something that might not be very easy if that outside party is not readily identifiable.
Right. A couple of things we often take for granted is when we're looking at an internal transition is that the employees are thinking the same thing as us. So a lot of times employees are in the dark and they're thinking mainly about themselves, which can potentially run into a lot of problems. If you don't have the right restrictive covenants, confidentiality agreements, employment agreements, and most importantly, communication, without even knowing that you have plans for an employee may say, hey, it's in my best interest to start my own business or go somewhere else where the owners are younger and there is a plan in place. And if you're losing the people that you think are going to be the next generation, that's putting you behind. And it's kind of almost a unicorn to think about that another company, whether it's a competitor or a larger company or somebody who wants to acquire your know-how, is going to show up and write you a check. That, as you can see from our earlier slides, that's something that a vast minority of the transactions happen that way. That even if you do have a sale to a third party, a lot of times they are going to expect you to be most or all of the bank. They're not going to come in with a check.
That takes us to the question, how is it that you're going to cash out of a business? Overall majority, based on that surety industry survey that I referenced before, was that it's going to be a sale or a transfer to someone that you know, in the sense of whether it's going to be employees of the company or to family members. I think the thing that really stands out on this pie chart is that cashing out, the large percentage of it is involved with the liquidation of a business. We're going to be talking about most of these exit strategies during the course of this webinar. What we're not going to talk about is liquidation. And the reason why is, from my perspective, almost never does liquidation of a business offer fair value to the business owner. It's the case of last resort that when all other alternatives have been exhausted, that's the way that you can reach an exit point. And from that perspective, very often you get involved with a situation where the client winds down the business. It feels almost like it's a failure of the business. And what we're here to talk about today are different ways that we can do this so we avoid that liquidation point.
Well, and also, you can almost, in a lot of cases, include sale to an outsider within that liquidation category. There's a lot of times a business owner may get an elaborate offer from a potential buyer, but when you really sift through and get to the bottom line of that offer, what they're really doing is giving you a discounted valuation on any hard assets you have and letting you keep your receivables, which essentially is the same thing as a liquidation.
And the who, what, where, when, why. I think we've talked about the what, which is the goal is to transition out of your business and get fair compensation for it. Very often, how that's accomplished is based on who it is that's going to be taking over from you. And so what are some of the options? You can sell your interest to a co-owner if you have a partner in your business, sell to a key employee, pass the ownership interest on to a family member. That's something that can happen through a sales situation, through estate planning, a lifetime gift, or you can sell your business outside of the organization, whether it's to a competitor, a company that's interested in entering into your market, or a roll-up firm that specializes in acquiring businesses and operating them for investors' accounts. The how and when is very much dictated by the who. Sale during your lifetime, I think that's the goal of most people, to transition on from their to the next generation. Gift during lifetime, most often that's only going to occur in a circumstance where you're going to be passing the business on to your children or other family members. So I've certainly been involved in circumstances where a key employee is the recipient of a bequest, whether at lifetime or at death by the business owner, gift at death, transfer by will, and forced liquidation at death. Again, going back to that notion, if there's no one else out there to take over, how are you going to wind down the business? Hopefully you don't get to that point. That takes us to where we start with. The overall majority of successful cash outs are done by a sale or a transfer to people we know, whether it's to family members or the sales to other business partners or key employees. So we'll start with transfer to business partners. A lot of us, when we start our business, we might have had a shareholders agreement if we have a corporation, operating agreement for an LLC. Something that's very common as part of the whole business startup process. And a lot of times after people sign it, they put it in the desk drawer and they forget what's in there. Very, very common in those organizational documents for business succession issues to be governed in those. I think one of the things you should ask yourself is, do you have one of those documents in place? And if so, what does it provide with respect to how business interests are going to be transferred in the event of a death or a disability of one of the co-owners. Just in the same way as you will be periodically reviewing your will to make sure that it reflects your intent, you should be doing the same thing with respect to those organizational documents, because that's a binding contract. And if you're not familiar with what's in there, it could be that you're going to find out about it only in a circumstance when it's too late, or it's going to be to your disadvantage.
Yeah, a couple of ways that may be too late or to your disadvantage is, well, one, not having one or not having it clearly defined. The next thing you know, you may be partners with your present partners, spouse and or kids, which, depending upon, of course, the people involved, may or may not do a good thing. Now, also, if you have a buy-sell agreement you've had in place for a long time, a structure that we commonly see clients bring in is one that provides for an agreed-for purchase price. Well, if there's an agreed-for purchase price that's been done 10, 15 years ago, that may be highly outdated. And in some cases, the agreement may provide that if it is outdated to a certain period of time, there may be a formula as to how the purchase price would be defined. Now, that formula may or may not be something that would be, one, expensive to have explored, because it could involve up to 3 business valuations at $15,000 to $20,000 a hit, or it could advise even arguing about who's going to do a business evaluation.
A lot of times people have questions with regard to the nomenclature that we use in these business succession issues and different terms such as a redemption agreement, cross-purchase agreement, what they are and the advantages and disadvantages of them. Whether it's governed by the terms of your operating agreement, your organizational documents, your shareholders agreement, operating agreement, or if you and your business partner meet and decide, you know what, one of us is going to buy out the other, and we're going to do a separate contract for it, structuring of the transaction. So a redemption involves the company purchasing the interest of the departing owner. Purchaser, in that circumstance, is the company buying back its stock, its ownership interest in the LLC. Cross-purchase agreement is where one of the other owners agrees to purchase the interest of the departing owner. 2 different ways to get to the same point, which is that one of the partners involved in the business is exiting, and at the end of the day, when all the dust settles, there's going to be one surviving owner. So with respect to redemption agreement, some of the advantages: simplicity. You have a single buyer, the company, that is going to be buying back its own stock. Very often, life insurance policies are used to fund the buyout in a death situation, and it's very simple for the entity to own a life insurance policy on the life of each of the partners in the business. Some of the disadvantages: tax effect with respect to this. The company's buying back its own stock, so in that instance, depending upon the type of business organization, there's some distinctions between whether it's organized as a C corporation, S corporation, or an LLC, which is typically taxed as a partnership. But one of the big disadvantages that's involved with this is because the company's buying back the stock, there'll be no step up in basis to the surviving remaining shareholder in terms of the value of that ownership interest. In addition, if not properly structured, there may be some income tax liability that's unforeseen that's involved with this. For example, the possibility that the transaction could be treated as a distribution rather than a capital transaction, so you'd be paying tax at ordinary income tax rates as opposed to the preferential capital gains rates.
There are a couple also of housekeeping items that are important that are sometimes done in haste or overlooked. That when we're buying life insurance, the life insurance agent is primarily interested in getting the policy in place, so of course they get paid. And when we're looking at who the owner of the policy is, who the beneficiary is, oftentimes those portions of the application are filled in in less than 30 seconds. And sometimes they're not filled in correctly. They're not filled in the same way for each partner. That, for example, in the case I'm working on right now, we have one of the partners, the policy is owned by the company, and the other policy is owned by one of the partners. Problem there, not to say anything bad about the partner that owns the policy individually, is that obviously that person can change the beneficiary without any notice to the other partner. Then in addition, you again have the policies in place, but no shareholder or buy-sell agreement in place. So there you have the possibility of somebody's family receiving life insurance under no legal obligation to sell the stock, either to the company or the other shareholder. So a lot of those details are very important to put into place.
Moving on to the cross-purchase agreement, probably comes as no surprise that the advantages and disadvantages that exist with respect to a redemption agreement are going to be reversed in the circumstance of a cross-purchase agreement. So you have a circumstance in which the remaining shareholder or shareholders are going to be purchasing the stock of the departing shareholder. And so in that circumstance, going to receive the benefit of a step up in basis. The basis in the newly purchased stock is going to be the fair market value, which is the amount that you're paying. In addition, you have the advantage of the life insurance death benefits that are going to be coming in. They'll constitute income as to the recipient. Some of the disadvantages is a clumsiness that's involved with a cross-purchase agreement, especially where you have multiple owners involved in the business. There's a two-person business, two-owner business, fairly easy to structure. Imagine a circumstance in which there might be 10 shareholders. Each one would be required to have a life insurance policy on the life of each of the other shareholders. In that circumstance, each one would own 9 policies on the lives of the other 9. Very difficult to administer. There's ways that you can work yourself around with respect to it. Some instances you can create a trust that's going to hold title to the life insurance policies. Really is going to be administered for the benefit of effectuating the buy-sell plan agreement. There's no right or wrong with respect to these things. Again, emphasizing the circumstance that it's not one size fits all. In these situations, what works for a business really depends upon the circumstances of your own individual business. Transfer of ownership to existing employees. It's important we kind of move from the level of law and into psychology in terms of what's involved with this process. And it is very much a circumstance. A couple of themes always stand out. First and foremost is a trust issue. When do you reach the level that, with respect to that employee, you feel that they have reached the point that you can trust them with the ownership of the business, especially if you're the one who's started the business and has developed it. In addition, very often employees are in a position that they don't have the financial resources in which to fund a purchase. They can only borrow so much at a bank. In a circumstance where an existing employee buys business, very often the departing owner ends up being the bank and funding part of the purchase, taking his purchase price and then an installment note.
Well, Brian, this also doesn't have to be a black or white situation, right? That rather than today I own all the stock, tomorrow the employees own all the stock, you can certainly set up plans where employees become vested in stock over a period of time. And that can be done in a variety of ways. They can be bonus, small percentages of stock, and in a case where employees lack capital, they can also be bonus cash to pay their extra income tax as a result of being bonus to stock. And they can also purchase the stock at a discounted value with the owner holding a note or a account receivable and being paid that, and that can also be done at a discounted value. And the idea as to why you may want to consider that is that you're beginning the process with the employees. You're beginning to have the employees invested. That sometimes it may be that the amount of gross revenues from 100% of the stock is actually less than the gross revenues from 95% of the stock because of the employee investment. Now, there are some complications, right, Brian, as far as bonding is concerned with that.
Yeah. There's third parties that are involved in the business sale situation. Those constituencies, your customers, your bank, your surety bond if you're in an industry where you're commonly bonded. There's those ongoing relationships. Very often, while it may at the forefront be with the business itself, very, very common for the individual owner to guarantee a bank loan, to enter into an indemnity agreement with respect to a bond. How do you extricate yourself from the business on an ownership level and yet retain the liability that's associated with those? This is probably where we spend most of our time and our emphasis and working through these type of details. And there's some instances in which you can make a clean break. If you're fortunate that you have the capital capacity that you can terminate a loan as part of the transfer out. If you just happen to be in your cycle and your contract that you don't have any balance outstanding, you can make that clean transition. That's very much the exception rather than the norm. And what you end up doing in these circumstances is there's a transition that's involved with this. It's not a clean exit in almost all of these circumstances. You as the seller have to weigh what is the level of risk that you have in terms of what's going to be involved. What's going to happen when things don't work out right? Do you want to have the ability to re-enter the business and take possession if there are circumstances? If you're getting a clean exit and you're getting cash on the barrelhead, I think the answer to a lot of those questions are very easy. But in many instances, as we alluded to, the seller ends up handling part of the financing for his purchaser. And in that circumstance, you have to think about the eventuality that if things go awry, that you're going to have to intervene in the business and take control again. We talked about some of the issues that you think about in a transfer to employees and some of the techniques that are involved with it. Again, going to nomenclature, make reference to an ESOP. That's an acronym for Employee Stock Ownership Plan. And for a lot of people who won't be familiar with it but may have heard the term before, think of an ESOP as it's kind of an employer benefit plan. It's like a profit sharing plan. The shares are purchased and held by a trust, the company making payments to fund the purchase. The employees have a beneficial interest in those shares that they maintain during the course of their employment. At the time that they depart, those interests are bought back from them for the fair market value. ESOPs you will not commonly see except for instances in which it's a very large employer that has a lot of employees. Much more common is the circumstance in which you're going to see a sale to a key employee or key group of employees. And in that circumstance, the sale can take a variety of forms. You can sell your stock interests so that they succeed to the corporation. Other instances, you're going to be selling the hard assets, the accounts receivable, the inventory, the equipment. To them, we're going to be talking about some of the different ways sales can be structured further in when we're talking about sales to a third party. So we're going to be revisiting this topic, and you're going to find that there's going to be a lot of the same issues in a sale to a third party that you have to a sale to a key employee. Moves on to our next category of potential successors to the business, and that's the next generation, your children, other family members.
Yeah, and also other employees. And that's where you want to look into a long-term plan. that really a minimum of 5 years. That one, you have to identify the best future management of the company and decide among family members if they're there, among employees if they're there. A lot of times, if we're dealing with a construction-related business, that may be a project manager. And if you remember, we talked about confidentiality and how to broach the subject. That one, you can look at, once you've identified your group, having them sign non-disclosure agreements. You can also obviously anticipate whether that's something that they may be interested in. In fact, that may be something employees are asking you right now. Where am I going to fit in here in 10 years? And that's a key thing in client retention. So it all kind of ties together. When we're looking at having confidentiality agreements, covenants not to compete, well, you can't get an employee to sign one of those and give the employee nothing. It's not legally binding. So if you're entering into a stock vesting plan for a relatively small amount of stock, that can be consideration to have them tied up. Similarly, you would also want to have provisions that if they leave, in addition to being bound by their non-compete confidentiality, they have to return their stock, either for nothing or for an extremely discounted value. We're going to get into what estate planning techniques work. And estate planning can involve actually doing things while we're still alive.
Whenever we're talking about transfer of the ownership to the next generation, especially in the circumstance where that next generation is going to be, the successors are going to be family members, it raises a lot of dynamics within the family. Probably the most common one, and the one that's most difficult for many clients, is how do you transfer the ownership to some but not all of your children, and the impact that has on the family as a whole. For many small business owners, the vast majority of their wealth is tied up in that business. And in an instance in where you're going to make an unequal distribution of that business to your children, the effect of that, when you look at your entire wealth, is that some will be getting more than others. And there's many clients who are troubled by that because they love their children equally. And reconciling how you're going to transfer the business with your feelings to your children is a difficult topic that many people struggle with. How do you counsel clients with respect to that issue, Wayne?
Well, there's several ways to look at it. Number one, if you have children that are already in the business, an issue relating to them is, well, based on their, let's call it sweat equity, would you view that the value of the business has been increased because of them being there? If that's the case, then perhaps their ultimate purchase or receipt of the business may be at a discounted value. Another thing, whether you're looking at a business or your overall estate planning, is to look at what your goals are. Whether you want to use the word equalize or the term equitize. Because let's say we are at the point where our kids are going to college, that maybe we have a child that's going to go to Bucknell. And I'm picking that out because it's a very expensive private liberal arts college. Maybe we have another child that's going to go to Penn State. Maybe we have another child that's going to go to an Ivy League school where they give grants rather than loans. So from a practical standpoint, you want to think about, are you going to write checks to the kids whose tuition is less so that you equalize what you're giving to the kids? And I may suggest in real life we probably are not doing that. And that's something we want to think about as part of our estate planning. So when we're looking at, let's say we're doing a transfer at death. We have a couple of options if the business is a huge percentage of our estate. We can have different categories of shares so that the children that are involved in the business may have the voting or management shares, and the other children may have non-voting shares, so that they do have value, they do have a right to receive income, but they don't have a right to manage the business or, heaven forbid, screw up the value of the business. We also want to take into account that if we have kids in the business, we want to make sure that in the event, heaven forbid, they have marital difficulties, the divorce lawyers are not coming in and going through all of our business records. So even if we're paying for prenups for our kids, we want to try our best to make sure that these future in-laws, in the event of a dispute, are not going to be going through the company books.
Yeah, another technique in addition to the use of prenuptials is to have restrictions built into your organizational documents. So again, referencing the shareholders agreement, operating agreement. When I prepare those documents for my clients, customarily, I'm addressing this circumstance in which a shareholder becomes involved in a divorce proceeding. What we're trying to do in those circumstances, we're trying to steer an outcome to this so that the ownership will remain vested in the constituency that we care about, our family members, our key employees, that departing spouse will not have some type of interest in the business. And I suggest that, again, if one of the things that you take away from this presentation is to go back and take a look at those organizational documents, again, because at the very beginning of a business relationship, preparing one of those things, you may not be thinking through all of these circumstances. These are an instance in which we can assist you by reviewing these and trying to button up any of these type of issues. So means by which ownership can be transferred to the next generation. Some of these are the hows and the way it happens. Lifetime gifting, lifetime sale, transfer at death, passed by will, or a combination of all. This is a process that we're going through. You reach an end result, but the combination of all is that you don't have to use any one of these techniques exclusively, and more often than not, it's a blend of all of them to get to that achievement. So the benefits to you in thinking this through and strategizing about it is that things aren't left to chance. You go in with a plan, and everyone is moving towards that plan, and you do it in such a fashion that the goal is that you're going to try to treat people equally to show your affection for all of them. And most important from what we can do to add value to is to try to do it in a fashion that's going to be tax advantaged. You want me to go back to another slide, please?
Right. When we talk about minimizing taxes, also how we do it comes into play, because most of us that have businesses are entrepreneurial, so that we've created them from virtually nothing, which means that we have a low cost basis. Now, when we make a lifetime gift, there's a couple of things involved in that. That the beneficiary of that gift gets actually the asset, however, they also get our cost basis. So that if we do a lifetime gift and the new owner then sells the business, they're going to be subject to capital gains tax. Whereas if, even with a family member, we use a lifetime sale, that's going to be able to give our family member basis. That is the value of the sale. Now, the slide you're looking at now, obviously from an income tax standpoint, we have a potential capital gains tax in the year of sale. We're going to show you a technique to postpone that. And under present law, we have less people subject to federal, estate, and gift tax, and you can see the exemption. And if we're married, you get 2 exemptions if structured correctly. So if we look at the value of the business are other assets, and life insurance that's not involved in a buy-sell, and our estates are under $22 million, we fortunately avoid the owner's federal estate tax, because the portion over the exemption amount, whether we're single or married, is subject to a 40% tax. There are some discounts available for family farms, family closely held businesses to lower that to a degree, but when we're up in that high dollar stratosphere, we do have that consideration.
Federal, state, and gift tax is one of the subjects that clients are very interested in. There's a lot of misconceptions and questions about it. I mean, maybe the first thing is people will ask is, who pays that tax?
And that's basically an option, that if I'm deceased, obviously I can't pay that tax. So my beneficiaries are going to pay that tax as a cost of receiving those assets. One of the things that I find that's very, very confusing to people is what used to be the $10,000 exclusion. And this really was more important back in the days when the federal estate tax exemption was in the $600,000 to $800,000 or even up to $1 million range. And people think that, well, I can only give a $10,000 a year gift. Well, number one, that annual exclusion gift is presently $15,000. And what that actually means is it's not a limit on gifts. It's a limit on the amount of gift that a person can make without eating into that person's exemption that is used in combination at lifetime and death. So that if I give one person a gift of $50,000 and I'm single, all I've done is use my $15,000 annual exclusion, and I've used up $35,000 of my approximate $11 million exclusion, so I'm not going to be paying any gift tax.
And Wayne, can you explain the concept of portability and how that applies with respect to the estate and gift tax?
Yeah, it used to be before and it was actually interesting, if we're interested in politics, that at the time we had the big jump up to the $5 million range of an exemption, we had a totally Democratic Congress and a Democratic president. And prior to that time, to take advantage of two exemptions, we had to basically divide estates into two parts and have two trusts. Because if the first spouse died without any assets structured correctly, that first exemption would be lost. So with portability, we can have very simplified plans, because when the first spouse dies, that executor can elect to give any unused exemption to the surviving spouse. So if we're married and under double the current 11 million plus exemption, we really can have still very simple estate planning.
In terms of the future of the federal, state, and gift tax?
Well, we've never appeared on any business channels on TV. The one observation I would make is the system of having exemptions and an amount of tax over the exemptions has never changed since 1986. 1986, the exemption was $600,000, and that's just increased, with the increases becoming more rapid in recent years. Right now, there's not really more than 200 federal, state and gift tax filed per year returns with the IRS. All of them are audited. It's an unpopular tax because basically you're being taxed on assets that you've paid income tax in acquiring, and the revenues that are received for it are a very, very small amount of the federal budget. So if I was to guesstimate, and I certainly can't guarantee, it would be very unlikely to see the exemption go down, and it would be more likely to see the exemption go up or the federal estate tax disappear. And that's been the trend when it comes to state death taxes as well, that exemptions have increased, and now we have a minority of states that even have death taxes.
One thing to keep in mind is that as it applies to family-owned businesses, many states have an exemption. Those assets can pass subject to the requirements. We have a national audience today, so it's beyond our purview to discuss the application of state inheritance and estate taxes on a state-by-state basis. But I'll just say that here in Wayne and I are in Philadelphia today. Here in Pennsylvania, we do have an exemption for the inheritance of family-owned business. You referenced there are a number of planning techniques that can be used to assist in this process of minimizing the impact of the federal, state, and gift tax. I was wondering if you could just kind of outline some of those and the advantages and disadvantages associated with them.
So first category, valuation discounts. And I spoke earlier about creating multiple classes of stock. So if I have voting stock and non-voting stock, and I can also put additional restrictions on non-voting stock, that's going to be worth less than voting stock. So if I'm making a lifetime gift of restricted stock, it's not valued for using my exemption at 100% of the value like voting stock would be. And we talked about the misconception about the annual exclusion gift. So essentially, this exemption of slightly over $11 million per person, I can give a total of $11 million this year and not incur any gift tax. However, the negative to my family is that they are going to get my low cost basis. So a lot of times to avoid that issue, we use a intentionally defective, and it would be a grantor trust, which means it's irrevocable, that we can't change that. We would use that as the buyer. So what do all those words in that acronym mean? So intentionally defective means it has certain buzzwords in it so that for some purposes it's a completed transaction, and for some purposes it's a non-completed transaction. So for the purposes of the sale, which would be ownership, it's a completed transaction, so that by selling to one of these types of trusts, I've removed that asset from my estate in exchange for an agreement of the trust, of which the new owners of the business would be the beneficiaries, which very well could be, and in most cases are my children. I'm receiving interest payments. Now, how do we fund all that? So a good example might be that if I'm running a business and I'm taking home, let's say $500,000 a year, and the real value of my services or replacement value is $100,000, $150,000, there's an extra $400 down to $350 of value. And that's really what you would attribute to goodwill. So that if I today engage in one of these sales, the benefits are the sale price, which is fair market value, is now the basis of the trust, which ultimately becomes the cost basis for my children, who are the owners of the business. And I'm not taking an income hit because of, instead of taking shareholder distributions and salary, totaling my $400,000 to $500,000 a year, I'm receiving loan payments would consist of principal and interest. So I'm paying income tax on the interest portion of that and no income tax on the return of principal. Now, I can also, for larger estates, add what's called a self-canceling feature to that loan, meaning that if I die or at the death of the later of me and my spouse, the obligation is forgiven. And as long as there's an increase in the interest rate to accommodate for that feature, then that's all perfectly fine. The benefit of that is that the remaining principal of that note may not count, or at least count a lot in my estate and keep me below the exemption amount. Now, I threw a lot at you with that, and obviously we can explain that in detail, but it's a wonderful technique.
How about family limited partnerships? That's a term that many people are familiar with.
Right. And that's often used for real estate, and it can be used really for two types of real estate. It may be used for real estate where I operate a business and I don't have it in an LLC. Best practices would have that real estate owned by an LLC. The problem in real life is that maybe I own that individually, and unfortunately, at least in Pennsylvania, New Jersey, transferring that to an LLC that I own is subject to real estate transfer tax, which is cost prohibitive. However, creating a partnership is not going to necessarily result in real estate transfer tax. So with a family limited partnership, the word limited means I can have limited partnership interest, meaning that they have no control. They can't decide when to sell the property, what the rent is, what the value of the sale would be. They can't even decide what color I may choose to paint it. So that I can, again, gift away discounted value so that if the building's worth $500,000, I may only be using $300,000 of my exemption to make that gift. And because I'm retaining even a 1% partnership interest, a general partnership interest, I retain total control. So basically what we're doing is two things. One, we're making a transfer at less than fair market value, but also because I'm now no longer the owner of 99%, any appreciation on that is not going to increase the size of my estate, but that appreciation is going to be owned by my beneficiaries.
And really, there's all of these techniques lead up to one thing, and that's to create a circumstance that's going to be advantageous to you and your family, and to the IRS, not nearly as advantageous. Retain that wealth that you have worked so hard to earn for your family. That moves on to our last category of the who, in terms of a business succession, and that's the transfer to outside parties.
And we've talked about that a little bit, that, that's our unicorn, right? Somebody's going to come along and want to pay us cash.
Yeah. I guess the question is, who is that going to be? And so we've talked about key employees. It could be a competitor who's looking to increase their market share. Someone who, a affiliated entity that is outside of whether it's your geographic market or your business area and is looking to make an expansion. And there's a whole variety of companies that specialize in what's referred to as rolling up businesses, consolidating, operating them for investment purposes. All of those are potential candidates. Whenever I'm talking to clients about selling their business, the first thing they want to do is understand what the distinction is between an asset sale and a stock sale. And so what's involved with an asset sale is the who's involved with it. Two-party transaction, might be more than two parties depending on the circumstances, but ultimately, fundamentally, what's occurring in that situation is your company is selling its business assets to the purchaser. The sales proceeds go to who is selling, the company. Typically, liabilities do not follow assets in a asset sale. So the liabilities stay with your company. What does that involve? Making sure that creditors are being paid, so they're not going to be chasing your sales proceeds, and that the potential downside that's going to be involved with leaving those liabilities behind is not going to outweigh the advantages that you're going to have as a result of doing the sale. So some of the advantages. From the perspective of the purchaser, they're able to cherry pick what it is that they're interested in doing. Easier to finance typically. Banks are more welcoming to an asset purchase as opposed to a stock purchase. And from this purchaser's perspective, typically it leads to favorable tax treatment. They're acquiring those assets at the fair market value, the amount they're paying for it. Disadvantages typically lie on the seller side. How are you going to deal with those liabilities that are left in the company? The transition can be messy. You have contracts. We've talked about bonds, loan obligations. And from the seller's perspective, tax treatment is typically not as advantageous. Moving on to a stock sale. What's occurring in that circumstance is you're selling your ownership interest in the company. Because you're the seller, the proceeds are coming to you. Assets and liabilities typically stay with the company. When you look at some of the advantages and disadvantages involved with it, it comes as no surprise that it's really the converse. From a seller standpoint, stock sale is typically preferable. You don't have to worry about resolution of those liabilities because they stayed with the corporation. Transition's easier dealing with customer contracts. In addition, from the seller's perspective, the prime advantage is favorable tax treatment, treated as a capital transaction.
Now, most of the techniques that we've used with family members and key employees work best with a stock sale. And the reason third parties prefer asset sales is the potential for liabilities because they don't have a company. So that when we're selling it to insiders and family, we don't have those issues of liability concern on the part of the buyers.
People hear the term merger and they really wonder what that is. And a merger is essentially a manner of amalgamating two businesses so that one survives and the second disappears. If you're involved in a merger, what's happening is your stock in your company is going away, and the sales proceeds accordingly are going to be paid to you. It can take the form of stock in the new company or cash. Typically for a small, closely held business, merger is not something that you see often. Some of the issues we talked about in terms of sale to a third party, when we're thinking about key employees, you're going to have the exact same type of issues. First and foremost is payment security. Can that buyer obtain outside financing? And if they can't, are you willing to take on the role of being its bank and to finance that purchase? What it is that you're going to require in order to handle that? You have the exact same issues with respect to handling bonding and guarantors. Heading towards the conclusion, I think what we'd like to focus on today is why have succession plan. You see some of the advantages and disadvantages we've talked through the process of retaining key employees, helping to maximize the business value, and to think about it and do it in a fashion that you're going to minimize taxes.
Yeah, and also, if we go back to the example I used with what you take home as compared to what the value of your services are, that translates into the concept of goodwill. So that to the extent that the purchaser, be they key employees or family members, sees that once they pay you off, that excess profit is going to go into your pocket, their pockets, that's really what goodwill is made of. And, you know, the whole thing about having a succession plan is to actually make sure that you and your family benefit from goodwill, that what you lose in a fire sale, a liquidation, or simply collecting your receivables or gifts is the benefit of goodwill. So if you do the right lifetime sale, you have a nice income stream that's secured, if properly done, that's going to fund the type of retirement and rest of your life to be able to do the things that you want to do.
As we're reaching the conclusion of our presentation, some of the action steps to think as you go and take away from this presentation is where do you want to go from here? First and foremost is you have to decide what it is that you want to do and how quickly you want to do it. Those run-of-the-mill steps will dictate where we go from there in terms of the process of gathering information, talking through the options. I think as you see kind of some of the advantages and disadvantages involved with this, having the right professionals that can advise you through the process, your accountant, your financial advisor, your attorney. Ultimately, though, this is your business. And when we said there's no one-size-fits-all, this moves, and it happens at the pace and the manner that you want to. You control the future. And so before you get started, again, know what it is that you're doing, take care of it, and have the advisors have all the information that you can be looking at the overall picture that's involved with this. And it's all based off of your timing. How soon do you want to get started on this, as Wayne alluded to at the beginning of the presentation. So it's a long, long process, 10 to 15 years you want to be looking at this.
Well, and you also want to look at it to make sure that you retain your key employees, that if they see a future, an ownership future, an opportunity to make more money, have more security, the timing is sooner rather than later to maximize the value of your business.
So as I said at the beginning, business succession planning is a process, it's not an event. You can't start too early, but you can't wait too long, and it can be fatal to your company. Wayne, do you have any final thoughts that you want to offer to our listeners?
Well, we appreciate the time that you've devoted to this, and it's great to see that we can see on our end that virtually everybody who started stayed with us to the finish. And as you can see from the graphic on this light side, on this last slide, bright light at the end of the tunnel, and it's our hope that the effort that you've put into, as well as the love and satisfaction in your business, results in you having the type of life after your business that you've always hoped to.
We hope that you found this information beneficial. The slides and the link to this recording will be circulated shortly, so keep your eye out for that email. And the link will also be available on our website, CohenSeglias.com. Feel free to contact either Wayne or myself with any questions about the topics we covered today. Thank you, and enjoy the rest of your